Hey there, future IAS officers. Ever wonder how India keeps its money situation in check? It's like a giant game of financial Jenga. The Reserve Bank of India, or RBI, is the master player. They've got a toolbox full of tricks to keep things stable. Think of it like this. The RBI is like the conductor of an orchestra, and these tools are their instruments. Each one plays a crucial role in keeping India's economy humming along. We're about to dive deep into the world of repo rates, reverse repo rates, and all sorts of other financial jargon. Don't worry, we'll keep it simple. By the end of this, you'll be able to explain it all to your grandma. Maybe. So, buckle up, Buttercup. We're about to embark on a crash course in the RBI's monetary tools. Get ready to impress your friends and family with your newfound financial knowledge. Just don't try to explain it all at once or their eyes might glaze over. You've been warned. First up, we've got the repo rate. The repo rate is the interest rate at which the RBI lends money to commercial banks. Think of it like this. Your bank needs some quick cash, so they go to the RBI for a loan. The repo rate is what they have to pay in interest. When the RBI raises the repo rate, borrowing money becomes more expensive for banks. Naturally, they pass that cost on to you and me in the form of higher interest rates on loans. So, if you're thinking of buying a car or a house, a higher repo rate might make you think twice. On the flip side, when the RBI lowers the repo rate, borrowing becomes cheaper. This encourages banks to lend more money, which can boost economic activity. It's all about finding the right balance. The repo rate is one of the RBI's most powerful tools. It's like the volume knob on the economy. By adjusting it, the RBI can influence how much money is flowing through the system. The concept of the repo rate has been around for quite some time. It's a fundamental part of monetary policy, not just in India, but globally. Central banks around the world use similar mechanisms to control their economies. The Federal Reserve in the United States, the European Central Bank, and the Bank of England all have their versions of the repo rate. These rates are crucial because they help maintain economic stability. By adjusting the repo rate, central banks can either stimulate a sluggish economy or cool down an overheated one. For instance, during times of economic boom, when spending is high and inflation is a concern, the RBI might raise the repo rate to make borrowing more expensive. This helps to slow down spending and borrowing, which can help keep inflation in check. Conversely, during an economic downturn, when spending is low and the economy needs a boost, the RBI might lower the repo rate. This makes borrowing cheaper, encouraging businesses and consumers to take loans and spend more, thereby stimulating the economy. The decision to change the repo rate is not taken lightly. It involves careful analysis and consideration of various economic indicators. The RBI looks at factors like inflation, growth rates, employment figures, and global economic conditions before making a decision. These decisions are then communicated to the public through announcements and press conferences. The impact of these decisions is far-reaching, affecting not just banks and businesses, but every individual in the economy. Whether you're planning to buy a home, start a business, or simply manage your day-to-day expenses, the repo rate plays a crucial role in your financial decisions. Understanding how the repo rate works can help you make more informed financial choices. So, the next time you hear about the RBI changing the repo rate, you'll know exactly what it means and how it might affect you. And that's the RBI's lending hand at work, guiding the economy through its ups and downs. Now let's talk about the reverse repo rate. As you might have guessed, it's basically the opposite of the repo rate. This is the interest rate that the RBI pays to banks when they park their excess cash with the central bank. Think of it like a giant savings account for banks. Why would banks want to keep their money with the RBI? Well, sometimes it's safer than lending it out. Plus, they earn a little interest on the side. The reverse repo rate is how much they get paid for playing it safe. When the RBI raises the reverse repo rate, it becomes more attractive for banks to park their money with the central bank. This sucks money out of the system, which can help to control inflation. Conversely, lowering the reverse repo rate encourages banks to lend more, which can stimulate the economy. See how it's all connected? The repo rate and the reverse repo rate are like two sides of the same coin. By adjusting these rates, the RBI can influence the flow of money in the economy. It's a delicate balancing act, but someone's got to do it. Let's dive a bit deeper into why the reverse repo rate is so crucial. Imagine a scenario where the economy is overheating, with too much money chasing too few goods. This can lead to inflation, which erodes the purchasing power of money. In such a situation, the RBI might decide to raise the reverse repo rate. By doing so, they make it more attractive for banks to deposit their excess funds with the central bank rather than lending it out. This action effectively reduces the amount of money circulating in the economy, helping to cool down inflationary pressures. On the flip side, during times of economic slowdown, the RBI might lower the reverse repo rate. This makes it less appealing for banks to keep their money with the central bank. Instead, banks are encouraged to lend more to businesses and consumers, which can help to stimulate economic activity and growth. It's a strategic tool that the RBI uses to maintain economic stability and ensure that the economy is neither too hot nor too cold. The interplay between the repo rate and the reverse repo rate is a fine example of how central banks manage monetary policy. By tweaking these rates, the RBI can either encourage spending and investment or promote saving and reduce inflation. It's all about finding the right balance to keep the economy on a steady path. Understanding these concepts can give us a better grasp of how monetary policy impacts our daily lives. From the interest rates on our savings accounts to the cost of loans, the decisions made by the RBI ripple through the entire financial system. So the next time you hear about changes in the repo or reverse repo rate, you'll know that it's all part of a larger strategy to keep the economy balanced and healthy. It's a complex dance of numbers and policies, but it's essential for the smooth functioning of the economy. And remember, while it might seem abstract, these rates have real-world implications for all of us. So keep an eye on these rates, as they are key indicators of the economic health of our nation. And that's the essence of the reverse repo rate. It's a powerful tool in the RBI's arsenal to manage the economy and ensure stability. Thanks for watching, and stay tuned for more insights into the world of finance. Next up, we have the cash reserve ratio, or CRR for short. This one's pretty straightforward. But don't let its simplicity fool you. It's a crucial part of the banking system. It's basically the percentage of deposits that commercial banks are required to keep with the RBI. This means that a portion of the money you deposit in your bank account doesn't stay with your bank. It goes to the Reserve Bank of India. Think of it like a rainy day fund for the banking system. Just as you might set aside some savings for unexpected expenses, the RBI requires banks to do the same. Let's say you deposit 100 rupees in your bank account. You might think that all of that money is available for the bank to use, but that's not entirely the case. If the CRR is 4%, the bank has to keep 4 rupees of your deposit with the RBI. This means that out of your 100 rupees, only 96 rupees are available for the bank to lend out or invest. They can't lend that money out, no sir. The 4 rupees are essentially locked away, inaccessible for any other use. It has to stay locked up tight. This ensures that banks always have a buffer of funds that can be used in times of financial stress or unexpected withdrawals. Now you might be wondering why the RBI makes banks do this. What's the point of keeping money locked away when it could be used for lending or investment? Well, it's all about managing liquidity and controlling inflation. By regulating the amount of money that banks can lend, the RBI can influence the overall money supply in the economy. By adjusting the CRR, the RBI can influence how much money banks have available to lend. A higher CRR means that banks have to keep more money with the RBI, reducing the amount they can lend. A higher CRR means less money for lending, which can help to cool down an overheated economy. When there's too much money circulating, it can lead to inflation, where prices of goods and services rise. A lower CRR, on the other hand, can encourage lending and boost economic growth. When banks have more money to lend, it can stimulate investment and spending, leading to economic expansion. It's all about finding the right balance. The RBI has to carefully calibrate the CRR to ensure that there's enough money in the system to support growth, but not so much that it leads to runaway inflation. Too much lending can lead to inflation. When there's too much money chasing too few goods, prices go up and the value of money goes down. Too little lending can stifle economic growth. If banks don't have enough money to lend, businesses can't invest, and consumers can't spend, leading to a slowdown in economic activity. The CRR is one of the tools the RBI uses to walk this tightrope. By adjusting the CRR, the RBI can influence the amount of money in the economy, helping to maintain stability and promote sustainable growth. Understanding the CRR is essential for anyone interested in how monetary policy works. It's a fundamental concept that helps to ensure the stability of the banking system and the broader economy. So, the next time you deposit money in your bank account, remember that a small portion of it is being set aside as a safeguard. This helps to keep the banking system robust and resilient, ready to face any financial challenges that may come its way. The CRR may seem like a small piece of the puzzle, but it's a critical one. It plays a vital role in maintaining the health of the economy, ensuring that banks have the liquidity they need while keeping inflation in check. In conclusion, the cash reserve ratio is a powerful tool in the RBI's arsenal. It helps to balance the needs of the economy, ensuring that there's enough money to support growth while preventing the excesses that can lead to inflation. It's a delicate balancing act, but one that's essential for the stability and prosperity of the nation.